Well, hi everyone. Welcome to the Buffett and Beyond Research Saturday Market Newsletter. And this building product stock is beating the S&P by triple over the past 5 years. Yep, it's called Installed Building Products, IBP for short. This is August 23rd, 2025, and there's one of those houses that they've built, or built the insides, I should say, of it. So let's just see what this stock does. But first, just remember this. If you want to be able to walk on this beach at sunrise like Jimmy Buffett used to do, you've got to learn how to invest even better than Warren Buffett does now. And we're going to show you exactly how we do that, folks. Okay, let's go over the stock. Installed Building Products, and they install 60% of the insulation, shower doors, closets, shelving, mirrors, garage doors, waterproofing, rain gutters, fireproofing, window blinds, and other 12%. Well, I can't imagine there's anything more than that. But it operates 250 branches in 48 states. Now, that's 30 more stores or 30 more branches than they had about a year ago. So they're still expanding, folks. And they serve homeowners, buildings, construction firms, and homeowners. And they have about 10,800 employees, which is another couple of hundred more than they had about a year ago. And look at this bottom part down here. Yes, they are part of the AI Buildout, and that's why we're going over this stock. Because not only do they do all of this in the building area, in home building, because they are in the home building ETF, but they're also starting to get involved with the AI data centers that are being built, especially by Amazon, all over the country. And so they call in a company like this and say, hey, do all this stuff for us so we don't have to do it. And then they get even more business. And that's what we're really talking about here. We're talking about not only the good performance of yesterday, but we're talking about what we expect out of this stock for the future. Okay, now let's take a quick look. The blue bars represent the average stock, and remember, the average stock is in the S&P 500, and folks, those stocks are above average, believe me. And don't forget, the S&P is not a static index. Everybody thinks it is, but they change 20, 30 stocks a year. They throw out the dogs and they bring in more stocks. So it's a moving target, which is why you don't hear money managers talk about it. But that's our benchmark, because 96% of professional money managers out there that are managing the publicly traded mutual funds cannot outperform these blue lines. Therefore, we want to pick stocks for our growth portfolio. And don't forget, over 22 years, we've outperformed the S&P 500 by 2.5 times to 1. So yeah, we're one of those people that can outperform. So one of the things we do is, when we look at a stock, the first thing we do is compare it to the S&P 500, and we're talking about the clean surplus return on equity, which is totally different than the traditional accounting return on equity. And so that's the first thing that we look at, and it's a comparable return on equity, so we can compare it against other companies and other companies in different industries. And that's what's so important about this methodology that was brought out by the accounting system a long time ago, but they don't use it because accounting wants to account for what's going on in each individual company, and that's different. In other words, who's got the Rolls Royce, who's got the home that was charged to the company, and things like that. So all that's removed, and what clean surplus says is, what is the actual money being earned on the investors' monies that are put into the company? Forget about the depreciation and all that stuff, folks, because this is a different method of calculating. So here we go. We're just doing a down and dirty outperformances. IBP outperforming a clean surplus return on equity? Yes, it is. Close to double, isn't it? How about net income growth? Now, net income is different than earnings, because net income is the real bottom line, not the earnings. And folks, you got to read the book to find out what that's all about, but very, very important. And yeah, almost doubling the average stock. And what about revenue? Yep. not quite doubling, but getting close to it. And you got to bring in that revenue, because that's the money that you bring to the bottom line. And of course, the percentages are figured differently, but they are very, very efficient. When you see this number, net income, higher than the revenue brought in, that means they're making very, very efficient use of the materials they have, the raw products they have, the construction methods that they use. Yeah, very, very cool on that. So we want to see this number right here higher than the revenue number. So now let's look at the numbers a little bit closer, and we can see the net income, and again, those are the clean surplus earnings, and we can see that for 2025, the home builders, because interest rates are higher this year, and I'm talking about 2025, and the home building has been in the doldrums. They were going crazy over the past couple of years. You can see this net income has been rising every year, but this year down a little bit from last year, but look at next year. They expect it to be at the highest that they've ever had, and we're looking at net income per share, of course. Now, the clean surplus return on equity, remember, the average stock is 13%. So this company is, even with the slight falter in the housing industry this year, we are still looking at a 21.2% clean surplus ROE for next year. And with the average stock, again, being 13%, we like to put stocks that have a clean surplus ROE of 20% or better into our portfolio, and this stock certainly fits the bill. Now, the retention rate is very, very important, because how much of the money it makes is it going to put back into itself in order to grow? And this stock is putting 83, 84, almost 84% of what it makes back into itself in order to grow. Where's the rest go? It goes out in the form of a dividend. Now, we like to see, in a growth stock, we like to see a small dividend, because we want to see this retention rate, which tells us if a company is growing or not. Now, some of the big companies that we remember as we were growing up, the Coca-Colas, the Pepsi-Colas, all those big companies, their retention rate's about 50% anymore. We like to see 100%, but we're 83%, 84% is close enough, folks. Now, years to pay debt, this is Buffett's rule of thumb. He says if a company takes all the money it's making and uses it to pay off the debt, how many years will it take to do that? His rule of thumb is 5 years or less. Our rule of thumb is around 3 years or less, and this company can pay off its debt 3.4 years, which is good enough for us, folks. So that means that this company is not bothered so much by higher interest rates in order to pay off the money that they've borrowed, but because the entire building industry has slowed down, that's why this company has a little bit more debt than usual. But if you take what it's going to make next year, this number, years to pay debt, goes down dramatically. So that's what we're looking at. And let's look over 1 year. Black line is the S&P 500. And you can see, because the housing industry has been very, very tough this year, installed building products went down. But boy, oh boy, in the past couple of months, as interest rates have fallen just a little bit, and the market expects the Federal Reserve to reduce interest rates a couple of times this year, we see this stock starting to take off before the building boom comes back. So it's taken off already, folks. And here it is, up 20%, while the market is up about 12%. So for a stock that's in an industry that is faltering right now and not in vogue, or I should say not in vogue at all, kind of like the health industry. Yeah, it's not doing too well either. So this is in the housing industry, not doing too well, but boy, oh boy, this stock is doing better than the S&P 500. Let's look at 5 years. Well, over 5 years, we can see that this stock was bouncing along very, very well. Then we went into the doldrums of the housing industry here, and now this stock is reaching new highs, all-time new highs, and the housing and building industry has not yet recovered. But what's the thought out there? Yeah, is it going to recover within the next 6 months? Yes, they think it is. The market thinks it is, and that's why this stock is reaching brand new highs as we speak. Now, I want to show you something else. The black line again is the S&P 500. This is over 5 years. And we used to have a company called Pool in our growth portfolio, which we got out of before this chart, over 5 years, about 5 years ago. We got out of it. It was doing very, very well, and then it started becoming an average stock. The blue line, I'm looking all the way back here, the blue line. And we're going to compare Pool, we're going to compare XHB, which is what? XHB is the house building or home building ETF. And we want stocks that outperform the ETF itself. So here you have the black line, which is the index, blue line, which is Pool. And boy, are we glad we got out of that stock. It's not doing very well at all because it follows the housing industry. Now, this red line in here is the XHB, which is the home building ETF, and we can see that it's now up above the S&P 500. This is over 5 years, up above the S&P 500 by a good chunk of the way. But look at our stock in here, Install Building Products, folks. It is doing fantastic compared to the XHB and compared to the S&P 500. These are the kind of stocks we want to see in our growth portfolio. And we have IBP in our portfolio for a long time now, folks. So, folks, we've had a tumultuous week. The market is just kind of meandering around, waiting for the Federal Reserve to speak. And as I'm recording this, the Fed chairman will say something late Friday afternoon or late this afternoon, because I'm recording this on Friday. And he'll have something to say. He's stuck between a rock and a hard place, so the market is just kind of meandering along, and we can see maybe a little bit more correction, and the Fed meets in September, and that's what the market's waiting for. Will they lower interest rates? If they do, housing takes off like a rock. Install Building Products is going to take off like two rockets put together. So, hey, it's the weekend. Go out, forget about the market, walk on the beach, walk on the golf course, be with your family. Most of all, take your mind off the market. And folks, stay safe. And we'll see you right back here in a couple of days.